Hello, good day. Economic analysis is the first step in the top-down approach of security valuation. In this video, I will discuss the theoretical and empirical relations between macroeconomic variables and share prices. For the purpose of this video, I have dig out my PhD dissertation to find information, as I studied this topic for my PhD research for 6 years. The explanation can be lengthy sometimes, but I hope you can see the relationship between macroeconomic variables and share prices from wider perspectives. It is hoped that at the end of this video, you will be able to understand the major forces driving the economy and stock market. It is vital for investors to appreciate the link between economic expectations and realizations and be wary of the potential forecast bias. Let's learn together. This video presents the basic information for analysis of the economy and the major forces driving economic growth. It is hoped that at the end of the video, students will be able to understand the purpose and contribution of economic analysis. We will review some of the key economic statistics used to describe the state of the macroeconomy. For example, we will examine how global and domestic economic environment, fiscal and monetary policy, GDP, productivity, unemployment, money supply, interest rate, business cycles, and market sentiments impact the overall investment environment and stock market. Why is economic analysis important? The prospects of the firm are tied to those of the broader economy. Fundamental analysis must consider the business environment in which the firm operates. Investors need to keep the big economic picture in mind. It is harder for business to succeed in a contracting economy than in an expanding one. The reason why the economy is so important to the market is simple. The overall performance of the economy has a significant bearing on the performance and profitability of most companies. As firms' fortunes change with economic conditions, so do the prices of their stocks. Of course, not all stocks are affected in the same way or to the same extent. Some sectors of the economy, like food retailing, may be only mildly affected by the economy. Others, like the construction and auto industries, are often hard hit when times get rough. It is vital for investors to appreciate the link between economic expectations and realizations, and to be wary of the potential for forecast bias. The ability to forecast the macroeconomy can translate into spectacular investment performance. But it is not enough to forecast the macroeconomy well. You must forecast it better than your competitors to earn abnormal profits. What is macroeconomic analysis? The macroeconomy is the environment in which all firms operate. The major forces driving the economy include demographics, productivity, and international trade. Economic analysis consists of a general study of the prevailing economic environment, often on both a global and domestic basis. Macroeconomic forecasting involves the study of business cycles, economic indicators, sentiment surveys, and changing expectations. Such analysis is meant to help investors gain insights into the underlying conditions of the economy and the potential impact it might have on the behavior of share prices. Economic analysis is the first step in the top-down approach. It sets the tone for the entire security analysis process. If the economic future looks bleak, you can probably expect stock returns to be equally dismayed. If the economy looks strong, stocks should do well. There are many factors that determine share price performance, ranging from domestic to international factors. The relative significance of the factors varies from one country to another, as well as the type of variables. These variables include inflation, exchange rate, industrial production, interest rate, money supply, oil prices. In this video, I will discuss the theoretical justification as well as the empirical evidence on their influence and significance. These variables are frequently used to explain stock return. The results has been mixed with some studies finding strong evidence of predictive ability for a given variable, while others find no evidence for the same variable. A top-down analysis of a company's prospect should start with the global economy. The international economy might affect a firm's export competitiveness and prospects, or the profits it makes from investment abroad. In addition, the global environment presents political risks of far greater magnitude than are typically encountered in local-based investments. The global economic analysis seeks to answer some key questions. For example, what is the global rate of growth? What is the current stage of the global economic cycle? What are the key geopolitical evolutions and risks? How would volatility and exchange rates affect global business? What are the overall prospects and greatest innovations in the global business environment? What are the latest developments in trade, international registration, and commercial treaties? At the time this video is produced, the COVID-19 pandemic has been severe around the globe. A deep global recession for year 2020 is inevitable. As seen from the figure, the drop in global trade was sharp and severe due to lockdown. In early year 2020, the oil price was $70 per barrel. It plummeted to $9 per barrel on April 21, 2020. The oil price recovery was helped by the agreement between OPEC countries to cut production. The empirical evidence on the influence of inflation on share prices is rather mixed. The negative relation between inflation and share price can be further explained in three ways. First, inflation can increase a firm's production costs, leading to a decrease in expected cash flow, corporate revenues, and profits, thus lowering its stock price. Second, an increase in inflation is expected to raise nominal interest rate. This in turn will increase the discount rate used in stock valuation, leading to an inverse stock valuations if cash flows do not adjust the same direction. The effect of a higher discount rate would be neutralized if cash flows increase with inflation. However, cash flows may not rise at the same rate as inflation because nominal contracts disallow immediate adjustments of revenues and costs of firms. An increase in expected inflation under general circumstances is likely to lead to economic tightening policies that would have a negative effect upon stock prices. Some studies argue that inflation may actually have a positive effect on stock markets under certain conditions, consistent with the Fisher effect, where the stock market serves as a hedge against inflation. The Fisher effect states that in the long run, inflation and the nominal interest rate should move one-to-one with expected inflation. This implies that higher inflation will increase the nominal stock market return, but the real stock return remains unchanged. Marshall in 1992 stated that if inflation is caused by money shock, it would lower the rate of interest and investors would shift their cash holdings to stocks and bonds in order to maximize potential capital gains. The increase in demand would in turn raise stock prices. An increase in expected inflation may also signal a potential increase in real activity, production, and hence higher stock returns. The relationship between exchange rates and stock prices has been highly debated with two competing perspectives. Exchange rates can be positively or negatively related to share prices. According to the flow-oriented exchange rate model introduced by Don Bush and Fisher in 1980, exchange rate movements initially affect the international competitiveness and trade position. This is followed by the real output of the country, and finally affects the current and future cash flows of companies, which can be inferred from the stock price movements. In essence, a depreciation in home currency is expected to stimulate domestic economic activity through increase in exports and domestic substitution for imports, thus boosting the domestic firm's profits and stock prices. Vice versa, an appreciation in home currency is expected to cause a decline in stock prices. On the other hand, exchange rate may be positively related to the stock prices. First, for an economy that is highly dependent on imports, currency appreciation reduces input prices and increases profit margin and share prices of companies. Second, a currency depreciation may generate expectations of future depreciation and subsequently drive portfolio investment out of the country. The demand for and value of local currencies are driven by foreign investors' willingness to hold local assets. Since an investment becomes more attractive when it is denominated in a strong currency, high exchange rate levels are associated with favorable stock price movements. Finally, a strong currency limits imported inflation and hence is perceived as favorable news by the stock market. The Industrial Production Index, or IPI, is often used as an indicator for real output or real economic activity in empirical work, since it is available at monthly frequency, while GDP data is only reported quarterly and annually. Industrial Production Index is pro-cyclical as it rises during economic expansion and falls during a recession. Therefore, it is commonly used as a proxy for the level of overall economic activity as compared to the GDP. The level of aggregate economic activity may influence stock prices through its impact on corporate profitability. An increase in output may increase future cash flows and hence rise stock prices, while a recession would have the opposite effect. However, the positive relationship between industrial production and share price is not unanimously confirmed by researchers. Interest rate and share prices are negatively related. Three types of explanations can be identified from the literature. First, according to stock valuation model, changes in the interest rate affect the discount rate used to calculate present value of assets and subsequently influence stock price. In addition, high interest rate raises the cost of capital, reduces corporate profitability and future cash flows, thus negatively affecting stock price. Second, from the substitution effect hypothesis, a raise in interest rate increases the opportunity cost of holding cash, leading to a substitution effect between stocks and other interest-bearing securities, such as bonds. Long-term bonds compete with stocks for investors' dollars. Thus, increase in long-term interest rates have a negative impact on stock prices from the perspective of asset portfolio allocation. Third, an argument that has gained prominence in recent years is the discouraging effect that higher interest rates have on mergers, acquisitions, and leverage buyouts. Nevertheless, theoretical disagreement exists. Some researchers find a positive relation between interest rate and stock prices. For example, Mukherjee and Naka in 1995, both in year 2001. Money supply may have either a positive or negative effect on stock markets. The positive relation between money supply and share price can be explained in three ways. First, an expansionary monetary policy stimulates the economy, raises the income level, and increases the cash flow in the hands of public, resulting in rising demand for stocks and other financial assets. Second, the portfolio theory suggests that an increase in money supply leads to a portfolio shift from non-interest-bearing money to financial assets, including stocks. Third, an increase in money supply could enhance stock prices via the liquidity effect. The higher liquidity in the economy reduces the interest rate and cost of financing, thus raising corporate profitability and share prices. In addition, an increase in money supply leads to an increase in the expected dividends and increases stock prices, assuming the interest rate remains unchanged. On the other hand, the relationship between money supply and share price can be negative. An increase in the money supply may lead to an increase in the discount rate and lower stock prices, since the rate of inflation is positively related to money growth rate. Second, the continued increase in money supply may exert a negative effect on the stock prices due to increasing inflationary pressure and subsequent policy orientation to contain pressure. Money supply fluctuations can affect the stock market through a policy anticipation mechanism. The relationship between money supply and stock prices is still an open empirical question. Many experts, however, believe that positive effects will outweigh the negative effects, and stock prices will eventually rise due to growth of money supply. Money supply has immediate positive liquidity effects and possible long-run negative effects. As oil is an essential input for production in the modern economy, it is reasonable to anticipate that oil prices affect stock prices. There are four channels through which oil price can affect share prices. First, an increase in oil price raises production, transportation, and heating costs and decreases future cash flows, hence affecting corporate earnings and share prices negatively. Second, changes in the price of oil may affect stock prices via its effects on the expected inflation and interest rate. Higher oil price places upward pressure on expected inflation. As inflation rate is positively related to the nominal interest rate and discount rate, stock prices are negatively affected. Third, any major movement in oil prices leads to uncertainties, which could influence investors to suspend or delay their investments. Therefore, financial risk of investment increases when there is a wide fluctuation in oil prices. Lastly, an oil price increase acts like an inflation tax on consumption, reducing the amount of disposable income for consumers as well as consumption spending. The ultimate effect of the price of oil on the stock market depends not only on what is happening to the oil price, but also whether the company and country is a net producer or net consumer of oil. Increases in oil price will be beneficial to those countries whose export products are derived from crude oil or refined oil products. Thus, there should be a positive relationship between the oil price and stock prices in those oil exporting countries. There is evidence that oil price dynamics have changed. The second oil price shock in 1979 was followed by a prolonged global economic slowdown that lasted throughout the 1980s. Almost all U.S. recessions since the Second World War have been preceded by oil shocks. On the surface, Malaysia stands to benefit from rising oil prices in the short run, firstly because of its net position as a net oil exporter, as well as price differentials between its export of high-grade crude oil and its import of low-grade crude oil for local consumption. Secondly, rising crude oil prices could also drive up other commodity prices like palm oil, tin, etc., of which commodity export now account for more than 15% of Malaysia's total export. The fiscal policy can be described as the government's taxing and spending policies. When the government spends more than it receives, it runs a deficit that must be financed with government borrowing. Any budgetary shortfall must be offset by government borrowing. Large amounts of government borrowing can force up interest rates by increasing the total demand for credit in the economy. Economists generally believe excessive government borrowing will crowd out private borrowing and investing by forcing up interest rates and choking off business investments. Monetary policy refers to actions taken by the government to influence money supply and interest rates. Monetary policy works largely through its impact on interest rates. Increase in the money supply lower short-term interest rates, ultimately encouraging investment and consumption demand. Business cycle is the recurring pattern of recession and recovery. The economy expands and contracts through a business cycle process. Business cycles are short-term swings in economic activity. They affect stock prices because they change investor expectations of risk and return. As the economy passes through different stages of the business cycle, the relative performance of different industry groups might be expected to vary. For example, at a trough, just before the economy begins to recover from a recession, one would expect that cyclical industry, those with above average sensitivity to the state of economy, would tend to outperform other industries. This is because purchases of these goods can be deferred during a recession. Sales are particularly sensitive to macroeconomic conditions. Other cyclical industries are producers of capital goods, that is, goods used by other firms to produce their own products. When demand is slack, few companies will be expanding and purchasing capital goods. Therefore, the capital goods industry bears the brunt of a slowdown, but does well in an expansion. In contrast to cyclical firms, defensive industries have little sensitivity to the business cycle. These are industries that produce goods for which sales and profits are least sensitive to the state of the economy. Defensive industries include food producers and processors, pharmaceutical firms, and public utilities. These industries will outperform others when the economy enters a recession. A demand shock is an event that affects the demand for goods and services in the economy. Examples of positive demand shocks are reduction in tax rates, increase in the money supply, increases in government spending, or increases in foreign export demand. A supply shock is an event that influences production capacity and costs. Examples of supply shocks are changes in the price of imported oil, freezes, floods, or droughts that might destroy large quantities of agricultural crops, changes in the educational level of an economy's workforce, or changes in the wage rates at which the labor force is willing to work. Understanding these concepts are important to investment analysis as it helps to identify the industry that will most help or hurt in any macroeconomic scenario you envision. The cyclical indicator approach to monitoring and forecasting the economy is built on the belief that the aggregate economy experiences periods of expansion and contraction that can be identified by the movement in specific economic series. Leading economic indicators are those economic series that tend to rise or fall in advance of the rest of the economy. Coincident indicators move in tandem with the broad economy, while lagging indicators move after the broad economy. The Conference Board, a non-profit business membership and research group, published the Leading Economic Index. There are 10 components in the Leading Economic Index. The leading indicators change direction in advance of general business conditions and are of prime importance to investors who want to anticipate rising corporate profits and possible price increases in the stock market. Leading indicators focus directly on decisions made today that will affect production in the near future. For example, manufacturers' new orders for goods, contracts and orders for plant and equipment, and housing starts all signal a coming expansion in the economy. Sentiment refers to the general level of optimism or pessimism. Consumers and producers' optimism or pessimism concerning the economy is an important determinant of economic performance. If consumers have confidence in their future income levels, they will be more willing to spend on big-ticket items. Similarly, businesses will increase production and inventory levels if they anticipate higher demand for their products. In this way, beliefs influence how much consumption and investment will be pursued and affect the aggregate demand for goods and services. In year 2020, sentiment indicators point to a severe recession. From the figure, you can see that the sentiment index falls off a cliff at unprecedented level. The first quarter of 2020 already saw a sharp contraction of economic activity as export to Asia declined due to the outbreak of the coronavirus in China. By the second quarter, the impact was even greater as the virus has spread globally, and governments were forced to take far-reaching public health measures to contain its spread. Let's have a quick quiz to test your understanding. Select the correct statements. The correct statements are 1, 3, and 5. Statement number 2 is wrong. Assume that the government decreases money supply. This action will cause investments to decrease. For question number 4, increases in money supply will cause prices to increase in the long run due to inflationary pressure. I hope you have learned something from this video. See you and goodbye.